warahmatullahi wabarakatuh. Thank you everyone for following this quick recording. I just felt in light of the current market conditions, it would be helpful to share some of the observations that we're seeing and some of the dynamics that are playing out in front of us in the market. My name is Ali Radawalji. I'm the CEO of Theoria Portfolio, and you probably have seen me in some of the prior recordings where we have covered market updates. So I just wanted to share something quick. This is morning of August 5th, Monday here, August 2024. And inshallah, find this helpful. If there's any questions that you guys have, feel free to reach out. We'll provide the contact. But I imagine a lot of you are thinking about some of the things that are happening out there. And our goal is to be able to keep you all informed with what is going on, so that you can be in the loop and also be able to make informed decisions about your investment journey, inshallah. So without further ado, I'm going to jump in. This is our standard disclaimer that we throw on all of our presentations, so feel free to catch that. Again, this is not intended to be financial advice. This is mostly for educational purposes, so that we can all be in the loop. So with regards to investing, I'd found this to be quite interesting. I thought this could be a good way to start off today's session. A lot of people sometimes have this notion that holding on to cash is a powerful thing, or is good. And yes, cash can play a role in portfolio management and in tactical situations. However, over the long term, if you are a type of investor or someone who is concerned about volatility and decide to stay out and on the sidelines, this history is showing us that over the past 30 years, you would have lost 54% of your purchasing power. So clearly, by putting your money into the markets, you're able to derive benefit and grow the value of your portfolio. So just something to keep in mind. But what is actually happening today? What is it that we're seeing? And it's not just today. Over the past few weeks, some of this has been brewing, but it often comes out in volatile moments like what we're experiencing today. So there is talks of the Japanese carry trade that is unwinding. What we saw was that the Bank of Japan raised rates to their highest level since 2008. And this is actually causing repercussions and knock-on effects on other markets. And we're also seeing that margin is one of the biggest things. You've heard us mention how the 2008 financial crisis, a lot of that was due to the leveraged positions. And sometimes people don't always learn from those past mistakes, but we've seen people borrowing money in the yen and investing in assets to provide a higher return. So such kind of gambling, quote unquote, behavior is leading to some of the things that we're seeing today. And what has happened is that the Japanese Nikkei index turned from being up 27% in the year down to experiencing a crash and pretty much the biggest one-day drop in history. There was a couple of other prior instances that we've seen where they've fallen down, but today is another notable situation that we've encountered. And we also saw that there was some halting and circuit breakers that were being put together in Japan. Similarly, South Korea, there was talk of them halting selling activity and as a way to mitigate some of the volatility that is coming about, from the Japanese situation. One of the other things that we're seeing, the Nasdaq and the S&P are both down. Nasdaq is very close to entering the bear market territory, and just a couple of weeks ago, 2-3 weeks back, the index was at all-time high. So things are not adding up. We don't just go from a all-time high to entering bear market territory unless there is something within the system that is not functioning as it should. And, we're seeing signs of what are the culprits causing some of these issues here today. Also, people are concerned Warren Buffett sold 50% of his Apple position. As you know, he has been a big investor in Apple. And, we can easily see that some of this could be just profit taking. It had become a very highly concentrated position in his portfolio, going as over 40%. So by trimming half of it, he's still going to be maintaining a decent amount, but part of that just could be that recession fears and other things that he was seeing that may have led to some of this. So just to keep that in perspective. And we're also seeing the fear and greed index being more on the side to extreme fear. So we'll explain a little bit about the fear and greed and some of the volatility in future slides. But I just wanted to give you a rough synopsis of what we are seeing. I'm sure there's other dynamics playing out, but these are some of the top things that we are noticing. This is one of the headlines as of today. So Bloomberg, has this market mayhem. We've seen probably in the past, markets in turmoil, the CNBC tends to have, and quite often, more often than not, I should say, those are usually indicators of close to bottoming situation that we are experiencing. So when you see headlines like this, they obviously can create an emotional response. But what is important to note is what is going on. So according to Mohamed El-Ari, a chief economist, I'm sure a lot of you have heard of him, there was a growth scare. There was, of course, the unemployment numbers kind of going up. So there is talks of the Fed being behind the curve, and economic data showing some weakness. And with some of these things happening, it's clear that it's contributing to some of the weakness in the market. But we'll cover again a couple of other things that we're seeing and some of the plan of action that we have in place. Well, I mentioned earlier, the fear and greed index is getting close to extreme fear. So if you just follow simple advice that Warren Buffett is famously quoted to have stated, be fearful when others are greedy and be greedy when others are fearful. So I know the impulse and the emotional response that a lot of people face when they see sell-off in the markets is maybe we should make a big change, a drastic change. Maybe we should raise cash. Maybe we should buy this or that. Just remember that fear is what is driving that decision, and that may not always be the best for you. So just be mindful of that. And know that, look, fear should be creating opportunities if you have a little bit of a long-term view here. So just be patient, hang tight. We are observing, monitoring the unfoldings of the market, and as and when we need to make any adjustments in the portfolio, our portfolio management team will be making those adjustments accordingly. So just wanted to point that out. Also, something that we're seeing with regards to the VIX, it has spiked to the third highest level in history. So this is unprecedented. The only two other times where we saw such a huge spike was during the financial crisis of 2008, as well as the COVID, big bump that we saw during the March 2020 timeframe. Friday, the VIX closed at 23, but as of this morning, it's already up over 65. So it's an indication that there is volatility kicking back in. But what does that tell us in general? Normally, when we experience such huge spikes in the volatility index, that forward 1, 3, 5-year returns tend to be very positive. So again, a reminder that this is not something that should cause us to panic. We have encountered these types of instances in the past, and we should just be looking to either deploy some of the cash. If someone is sitting on some cash, this may not be a bad time to look at taking advantage of the dips that we're seeing and dollar cost averaging, or at least maintaining what you have, because clearly the forward returns tend to be positive following such events. I'll talk briefly about Bitcoin here. A lot of people are talking about this being a bear trap. It's obviously being seen as a little bit higher sell-off compared to other markets like the NASDAQ even. And, in the beginning, Bitcoin does behave more as a risk on a type asset. So whenever there is risky, developments in the market that cause fear and uncertainty, the sell-off in Bitcoin tends to be a little bit more extreme. But one thing to keep in mind, and I just came across this Matt Hogan, who is the CEO of Bitwise, I believe, he just mentioned the last time global capital markets panicked was March 12, 2020. Again, clearly the spike in the VIX, coincided with the same time. And, Bitcoin price fell 37% that day. And what happened was we saw a drop from 7,900 to 4,900 at that time. But what happened a year later? From that moment, Bitcoin was at $57,000. So clearly this fear-induced situation, volatility should not be something that shakes investors' hands. We should be, mindful. Of course, I'm not advocating for Bitcoin for everyone, but this is something that we are seeing as an observation based on past history, and we should be mindful of what that brings about. But if you have that longer term view, this could be a good opportunity to get into a hard asset like Bitcoin, and it could rebound here in the weeks and months to follow. So just keep that in mind. The other thing that's happening around the world, there's a lot of geopolitical concerns. And this is a headline that I'm sure a lot of you have been following on social media and other news channels. These tensions between Israel and Iran. Iran has been, in the news a lot more, and Israel as well. And the assessment is that there's likely going to be an attack in the coming days, following the assassination of Hezbollah military chief, as well as the Hamas leader Ismail Haniyeh in Tehran. So Iran has blamed Israel for Haniyeh's death and has vowed to retaliate. So some of this is obviously causing the jitters in the market. We've seen stocks like Lockheed Martin, they were up overnight. So obviously the military industrial complex does benefit from these types of headlines and risks out there. But again, we just want to be mindful that this is one of the elements that's causing some of the weakness out there. What are we seeing with regards to rate cuts? Of course, our job is to not be on either side. We are praying for safety and peace to prevail. We do not want to see any kind of bloodshed and escalation in these types of situations, because ultimately our goal is to ensure and pray for peace to prevail and cool heads to kind of work towards strengthening peace in the area. But we also want to be mindful of this is what's going on, and I'm just sharing the information as I see it. So with regards to rate cuts, the probabilities have shot up to 100% almost. We're going to see 50 basis points rate cut. Just a few weeks ago, it was close to 50%. And just actually a few weeks ago, it was just at 25 basis points, but now that has shot up to a 50 basis points rate cut in September. And there is an emergency Fed meeting that has been called this morning, so we will see what comes out of that. But just want to point out that economic conditions, which we've been saying for quite some time, should come down. Inflation has been falling like a rock, so there is no reason to keep the conditions tight. But here we are, and I think a lot of people are calling that the Fed has been behind the curve when inflation was skyrocketing. They were they were using the term transitory and were not early in raising rates. And now that we have seen inflation coming down to the 2% levels, they should have cut rates earlier. But again, they seem to be behind the curve, and that's what's causing some of the jitters as well. But probabilities are increasing for rate cuts, and that should be positive going forward. And this is just another chart that shows the relationship between the Fed's fund rate and the 2-year note. So the 2-year note is signaling that the Fed is behind. So a lot of people use that as an indicator to understand where is the Fed in relation to where they should be with regards to their cutting or easing of the rates. And the 2-year yields have fallen further depending on the conditions in the US. So with interest rates falling, the consumer is still, so the positive lining here is look, consumer is still in good shape for the most part. I mean, a lot of earnings of the reports that we've been seeing on the S&P have been positive for over 80% of the companies that have reported. So it shows that there is a good amount of spending still happening in the economy. But this is more like a growth scare is what we believe is kind of playing out here, recession fears and other things kind of playing out. But we do think that the Fed, once they start the easing cycle, this should hopefully and what the commentary comes out of Federal Reserve Chairman Jerome Powell will be key to observe kind of their path going forward. So this is kind of some of the correlations that we're seeing. This morning, Professor Jeremy Siegel called for a 75 basis point emergency cut in the Fed funds rate. And he actually has also called for another 75 basis point cut in September at a minimum. And Professor Jeremy Siegel, he's a professor of finance at Wharton School, so he's well renowned. He's been in the markets for many years, and he was pretty strong on his call here this morning at the CNBC invitation. And I think that this kind of echoes some of what we have been observing and stating, that the rates should be coming down. But again, the Fed will have to be, the ball is in their court. And if you couple that with some of the geopolitical stuff, we could see things happening rather quickly here to bring down the rates. But most importantly, as a long-term view, earlier I pointed out at the beginning of the presentation why it is important to invest. Even in the last 30 years, we've seen the financial crisis, we've seen the COVID crash, we've experienced the tech bubble, among other things. And despite that, the S&P has gone up. And if you held on to cash, your money would be depreciating in value due to the loss of purchasing power. And so one thing to keep in mind is, this chart here shows all the different things that we've encountered, crisis, wars, and yet the markets go higher. So it's important to keep this in mind and not be reactive when we encounter volatility, and instead should be remaining calm, cool, calculated, focus on your goals, and inshallah you'll be in good shape longer term. So again, I just wanted to leave you guys with something brief, quick, to share our observations with what is happening. And if you need to reach out to us, you have our contact information here. Get in touch with your advisor. But again, cool heads will be what is needed in these kinds of situation. Remain cool, calm, calculated. Make sure you're moving in a very calculated way. Make sure you're not reacting in a way that would make you regret some of the moves. So just be careful. And if you need to discuss it, we are here to talk to you. Inshallah, all the best. Thank you. Wassalamu alaikum wa rahmatullahi wa barakatuh.